Welcome to my channel. Welcome to a new podcast. The title is Why the Gold Bull Market Has Only Just Begun. If you are interested in this topic, you will definitely also be interested in Dr. Polleits Boom Bust Report. All information at www.boombustreport.com. Don't miss it. And now let's get started. Why the gold bull market has only just begun. As an investor, it pays to be cautious, to think through various scenarios carefully, to constantly review your own assessments critically, but at the same time not to be a weather vane blowing in the wind, not to let yourself be distracted by media spectacle, and not to be swept into wrong decisions by the ups and downs of the financial markets. This applies especially, and perhaps even particularly, to precious metals investors, those who buy gold and silver for wealth preservation and capital appreciation. As an investor, you certainly know that the only constant in life is change. For instance, companies come and go. They are founded, rise, sometimes fall again, some reinvent themselves, others disappear completely. Gold is different. It does not change its physical properties over time. It is, so to speak, what it is, and it will remain what it is. Moreover, once gold has entered humanity's possession, it does not disappear again. It is used but not consumed. Its available quantity gradually increases over time through new mining output. And the total amount of gold grows only relatively slowly, on average by just under 2% per year since the beginning of the 20th century. By the way, far less than credit and money supplies are expanded in the developed countries. What usually shows major changes with respect to gold is not so much the supply of gold, but rather the esteem and appreciation that people have for the yellow metal, in other words, gold demand. The yellow metal is in demand for industrial purposes, jewelry, and investment. All these demand components contribute to total gold demand, and they diversify and stabilize it. For example, if investment demand for gold rises sharply and the gold price rises accordingly, industrial demand for gold falls. Gold is used more sparingly and/or replaced by substitute materials wherever possible, reducing the upward pressure on the price of gold. Conversely, if the gold price falls because monetary demand for the yellow metal weakens, industrial demand rises at the same time because gold is now cheaper to use in production, and this supports the gold price. In this sense, there is a certain automatic, built-in stabilization of gold demand. However, individual demand components can and do change substantially beyond the short term. Since the beginning of the 21st century, at the latest, it can be assumed that monetary gold demand has once again gained significantly in importance in gold price formation. The growing problems in the international credit and fiat money system are, on balance, driving total demand for the yellow metal higher, translating into a rising gold price. Gold is increasingly in demand as a store of value, especially also as portfolio insurance. The concerns of investors driving these developments are well-founded and manifold. Many fear the collapse of the global debt pyramid, or that central banks will monetize debt ever more strongly, thereby driving inflation higher, or that savers and investors face defaults that could destroy their capital. In such an environment, gold is in demand. After all, the purchasing power of the yellow metal cannot be debased by central banks running the electronic printing presses. It carries no default risk, and it can be withdrawn from the banking and financial sector. And, last but not least, the marketability of gold does not proverbially depend on electricity. At present, there is unfortunately no sign that the rulers and the ruled in the Western world want to halt and reverse the pernicious trend fed by the credit and fiat money system. On the contrary, they are sticking to excessive debt, instructing central banks to lower interest rates, keep them artificially suppressed, and continue expanding credit and fiat money supplies ever further. Yet the hope that the economies might somehow grow out of their problems in this way is rather slim. The probability that the world's economic and financial system will be pushed wide-eyed into a big crisis, and that such a crisis will be met with even more debt, even lower interest rates, and even more money creation is, by contrast, quite high. The question therefore arises, what further consequences will all this have for the gold price? This question can perhaps be answered more easily if we decompose the gold price. In this sense, gold's market price, that is, the nominal gold price, equals the real gold price plus a price inflation premium plus a credit default or risk premium. The real gold price represents the relative price of gold vis-à-vis all other financial instruments, such stocks, bonds, etc., and other goods, such as, say, real estate. The price inflation premium reflects the expected loss of purchasing power of fiat money. And the risk premium is the price that market participants are willing to pay for holding gold to protect themselves against payment defaults. Such a decomposition may help us better understand the dynamics of the gold price. For example, let us think about the following situations. If goods price inflation moves within generally accepted bounds of, say, an average of 2 to 4% per year, the nominal gold price also rises in this order of magnitude due to the price inflation premium, without the real gold price or the credit risk premium changing. If inflation rises above the level accepted by the population, say to 4 to 8% per year, not only does gold's price inflation premium rise accordingly, the real gold price can also expect it to go up, because holding gold now becomes more attractive relative to other asset positions, especially, say, bank deposits and debt securities. And if market participants fear defaults that the central bank will not be able or willing to avert by printing new money, both the real gold price and the default risk premium in the price of gold rise. Against this backdrop, it appears that since the beginning of the 21st century, the price of the yellow metal, which stood at around $257 per ounce at the time, has probably risen to now $4,200 per ounce, because both the real gold price and the price inflation premium have increased. Credit default concerns in the markets have certainly also played an important role in the rise of the gold price. However, and this is important to understand, credit default fears have been receding since the great crisis of 2008 and 2009 was overcome, and the risk premium in the gold price has therefore probably been relatively subdued or even declining. With the politically dictated lockdowns in 2020 and 2021, the real gold price and the price inflation premium then rose strongly, more than compensating for the still subdued or even declining risk premium. Especially the explosive rise in the gold price in the last 2 years, during which it has almost doubled when measured in US dollar, can be explained by a higher real gold price and an elevated price inflation premium. The important, indeed decisive question, however, remains. Has the gold price rise already gone too far? Is gold now too expensive? Or is it still too low? Or is it just right? There are good reasons to assume that the gold bull market of the 21st century has probably only just begun, that it is far from over. The major problems that are still to come have very likely not yet appeared at all, or only inadequately on most market participants' radar screens. Over the next 12 months, therefore, the chances are quite good that, cautiously estimated, the price of 1 troy ounce of gold will reach at least the 5,000 mark in US dollar. That would be a return potential of roughly 20%, starting from the current price of around $4,200 per ounce. From a risk and reward perspective, it makes sense for the long-term oriented investor to allocate a portion of his investment assets to gold, since the chances are quite good that the 21st century gold bull market has essentially only just begun. If you want to know how to position yourself sensibly as an investor and what you should do now, I recommend you read Dr. Polleits Boom and Bust Report. You will find all the information at www.boombustreport.com. And now I say thank you very much for your attention.